Good morning. My name is Simone Parker. I'm with Stakeholder Relations. It's our privilege to host today's webinar on investment returns and how they impact your rates. Today, I'm joined by our new Chief Investment Officer, Stephen Gilmore. He's been here for almost 2 months now, I believe, so I'm not sure how much longer we can say that he's new, but we appreciate his time. In addition, we have Scott Terando, our Chief Actuary, and Rob Paterson, Investment Director over our investment technology data and performance. And next slide, please. Today, the panelists will provide a summary of our investment performance for fiscal year 23-24. We'll cover the impacts that these investment returns have on our employer contributions and a look ahead on our upcoming asset liability management cycle. The team will include a copy of the slides in the chat if you want to follow along that way. With that said, I will pass the virtual microphone over to Stephen. Thank you.
Thanks very much, Simone. Yes, I am new. I've been here 2 months now. I think the reality is it will feel new to me for quite some time to come. There's so much to learn. I've been very welcomed by the team and I'm really enjoying it. But time is passing very, very quickly. Renee, if you go to the next slide. We put up here the returns. For the last year, the fund returned 9.3%. That's a good outcome in terms of what our expected return is and the return that we need to gradually improve the funded ratio of the fund. You can see we've highlighted the 6.8%. That's what we refer to as the discount rate. If we achieve that, given all our assumptions are hold, if we achieve that over a 20-year period, we should take the funded status up to 100%. Right now, with the 9.3% return, our funded status has increased from 72% to 75%. So just to re-emphasize, over the 1-year period, we earned 9.3%. Which is above our target return, which is good. But of course, we are a long-term fund, and we really need to focus on that long-term rather than sort of the 1-year outcomes. Over a 30-year period, we've generated returns of around 7.7%. If you go to the next page, this page sets out the investment portfolio, the allocation to various asset classes. As you can see, we have 37% in public equities, 28% in fixed income, 70% in private equity. Real assets, that's primarily real estate and some infrastructure, and a small allocation to private debt. The main changes in recent times have been to increase the allocation to private equity and to increase the allocation to private debt. This is really a case of essentially switching from liquid equities or listed equities to private equity and from liquid fixed income to private debt. And we do that because we think the prospective returns, the risk-adjusted returns in private equity and private debt are better. And just on that subject of returns, if you can go to the next page, you can see that private debt, for instance, returned 17% over the past year, which is a really, really good performance. In many ways, I wish we had a greater exposure to private debt. It's only a very small part of the portfolio. Public equity, on the other hand, returned 17.5%, the strongest performer. And that, of course, is where we have the largest asset allocation. You'll see private equity at 10.9, still well above the 6.8, but it's lagged the public equities. Partly that's a function of the way the valuations work, and partly because of the very strong returns to the tech sector, which is strongly represented within public equities. I'll pass over to Rob to talk a little bit more about some of the detail in terms of the returns of the asset classes and returns through time.
Thanks, Stephen. Great, so we'll move on to the next slide. So as Stephen mentioned, we posted a return of 9.3% for PERF last fiscal year, and had an ending market value of approximately $503 billion. So that's approximately a $40 billion increase year over year from a net asset value or AUM perspective. As we look at the right-hand side, we can see displayed graphically the returns that Stephen just described. And unpacking those a little bit, what we can see is a public equity, which is that far left-hand column under the 1 year, posted a return of 17.5%. Some drivers of that, we have a large allocation within that to U.S. equities or public equities within the U.S. market, and those returned greater than 25% over last fiscal year. And then further within that, we can see that both communications and also technology were the leading sectors within U.S. equities, posting returns in excess of 40%. This is where you're going to see names like, Meta and Google or Alphabet, within the communications sector, or NVIDIA, and possibly to a lesser extent, Microsoft within the technology sector. We saw that international markets also posted strong returns, but about half of what we saw from U.S. equities. As we look at fixed income, which is that shortest but positive bar, we saw that that posted a return of 3.7%, with our long duration treasury segment posting slightly negative returns, but more than offset by some of the returns within the credit segments. And then we can see private debt, as Stephen mentioned, posting return of 17% and 10.9% from private equity. So as we zoom out from these returns, we can see on the right-hand side a bit of volatility in terms of changes in returns, not all segments having positive returns. But when we look at the 5-year period or the 10-year segment, things begin to stabilize a lot more along the lines of our expectations. Where, for example, on the 10-year, we see public equity and private equity return posting the highest returns, as we would expect, because those are our growth-oriented assets, where we expect those higher risk assets to generate higher returns over longer periods of time. If we move on to the next slide. So what we wanted to do here, what I wanted to share, is a little bit of context about how one can think of a portfolio total return. You can think of a portfolio total return as being a combination of what the benchmark does, which is the implementation of the strategic asset allocation, which is what Stephen mentioned a couple of slides ago, as well as what we consider the active or value add return, which is the incremental value add from implementing the portfolio or active investment strategies. So as we look at the left-hand side, what we can see is what each one of the asset class benchmarks returned. And what we can see is the primary drivers of the total return of the benchmark come from public equity and private equity, where that's the dominating, the growth aspect of the portfolio return is dominated by those two components. We can also see income contributing 1.1% from its positive 3.6% benchmark return. And then some of that being offset by real assets or its benchmark that detracted nearly 2%. So if we look at all of those components, that's effectively what brings a passive implementation of the portfolio, conceptual portfolio, the benchmark, generating a 10.3% return in the policy benchmark. And then you can see the value add, which is negative by 1% or 100 basis points, which that really comes from the fact that our private equity program underperformed its respective benchmark, really because we're measuring private assets relative to a public equivalent that is marked on a daily basis, and we would expect that to kind of play out over time. That then brings the 10.3 benchmark return less the incremental value add from implementation to a total perf return of 9.3%. If we move on to the next slide. So when we look at returns, whether it's going to be total returns or it's going to be active returns, I think it's helpful to look at those through the context of expectations. What did we expect those returns to be? And also recognizing that the way that we generate or achieve investment returns is by accepting uncertainty. And we expect to be compensated for that uncertainty, which we refer to as risk or investment risk. So as we look at this particular chart, what we can see is the gray line in the center of that cone shape is really the cumulative return that we expect over time. You can then see that the dotted lines around that really setting our expectations of, we know that we have an expected return, but given the uncertainty, we need to have a range of expectations. where that broad dash refers to the expectations we would expect about 2/3 of the time. And then that smaller dotted line, or the broader cone, reflecting the expected return range that we would expect about 95% of the time. And then what you can see plotted down the middle of that, along that gray line, is our realized cumulative return over time. And you can see that that very much tracks with our expectation over time, very much within the ranges that we would expect. And so as we look at that, while we're kind of generating the total return that we would expect, we can also recognize that that journey is not always smooth. It's a path that will have ups and downs. We expect that from an investment perspective. This has been quite positive this last year, and that our focus into the future will really continue to be on generating increased active returns. And so with that, I'll hand it back to you, Stephen, for additional perspectives.
Thanks, Rob. You can go to the next slide. Now, Rob's talked about the returns, and he's talked about, the volatility of the returns. The biggest driver of the returns of the PERF simply comes down to what's happening in the financial markets. And there, the biggest influence is going to be what happens in the equity market. But we think we can potentially do better than that, or we should be able to do better than that, by playing to the strengths that CalPERS has. And here are 4 of the strengths that we identify and like to focus on. One strength comes with size. Now, sometimes size can be a disadvantage because you can't invest as much as you would like in certain areas because there are market constraints. But the other side of that is size allows you to negotiate more. It allows you to do more stuff internally as well. So that can be an advantage. And there's usually quite a close association between size and the average cost of investing. So we can take advantage of that given who we are. Long horizon, also very important. Because of that horizon, because we are very long-lived, we can look through some of the volatility, and that gives us an advantage. It allows us to buy things when they're relatively cheaper. At the moment, you will see that we have been increasing our allocation to private equity. This is a time when some of our peers are pulling back because they don't have the liquidity. That horizon means that we can actually, and that, I guess the combination of horizon and liquidity means we can take advantage of that. So again, something that adds value. The brand, really important. People know who we are. It opens doors. People want us as an investor. So that is another advantage. And the 4th one I put down here is internal knowledge. We have a really good, a highly capable, dedicated team of professionals who are forever meeting with people in the markets. We are actually getting lots of information on what's going on. And by collating that information, by looking at the themes, looking at the trends, we can also add value. So those 4 areas together reflect some of the strengths that we can use to do better than what the market is offering us. If you can go to the next page. Here, I've highlighted the areas of focus over the year ahead. And those areas really line up with the enterprise strategic initiatives. The first thing I've put down here is talent and culture. This is really a people business. We need to back our people. We need to develop our people. We need to ensure that we've got a great work environment and so on. So here, there's a big focus on culture, engagement, collaboration, and continual improvement. It's one of the things that is an objective for me, and it cascades down to the rest of the team. I would say that I've been really very pleased to see the way that an internal culture club has taken hold. It's come up with a whole series of experiments and initiatives to try and improve culture and engagement, and I want to remain closely involved in that. The second focus area relates to data and technology, and this is an area that Rob is deeply involved in. This is about having the information and being able to use and analyze that information to make better investment decisions. Historically, we haven't really spent that much on data and technology. And now we're going through this process of thinking about how we can improve the overall portfolio understanding through updating our technology stack. This is something we'll be focusing on for the next few years. There's no sort of quick wins or quick solutions here, but it is something that can potentially allow us to leapfrog others. Third area, the portfolio. One of the biggest initiatives that we're embarking on is our regular asset liability management review. This happens every 4 years, and Scott will talk to that after I finish speaking. But the focus here is on trying to get the best portfolio. So we're looking at prospective returns, we're looking at risk, we're looking at our overall risk appetite, and we're looking at, as I say, trying to construct that portfolio that gives us the best combination of return for the risk we take. At the same time, you will probably be familiar with one of the very big initiatives that we've undertaken, which is Sustainable Investment 2030, where we're aiming to invest $100 billion in climate-related solutions. That's also part of that portfolio focus. So putting that talent and culture, the data and technology, the portfolio initiatives together should all, we believe, lead to better performance and an improved funded ratio. And with that, I'll pass back to either Simone or to Scott.
I say we hand it off to Scott.
All right, thanks, Simone. Next slide, please. So the next part we're going to kind of talk about over the next section. We're going to talk about what's this mean for employers. We're going to cover what the investment return means in terms of contribution rates. I know a lot of questions always come up about how the rates are going to be affected by the returns that we get. So next slide. Just quick review here. Our expected return was 6.8. We got around 9.3% for the fiscal year. And that puts us approximately around 75% for a funded ratio. That's, again, for the PERF overall. Your individual plan will have a different funded status. Next slide. For public agencies, this investment return impacts the 26-27 fiscal year contributions. So that's 2 years from the 2024 end of the fiscal year. Keep in mind, this delays there to provides us ample time to get the valuations done, and it provides also, lead time for employers to plan in their budgets for any contribution changes. Also, during the 23-24 fiscal year, the higher return triggered what's called the risk mitigation event. For those that aren't aware, we have a risk mitigation policy where when we have additional returns, we take a look at the discount rate and make some possible adjustments. If we go to the next slide, we cover that in more detail. So basically what happens is when we have excess investment returns, we take a look at, we have what we call thresholds. So you can see on the far left, we have 2, 7, 10, 13, and 17%. For just this recent year, our return was just over 6.8%. So we eclipsed the 2% threshold. And this brings up a reduction, or I would say a possible reduction in the discount rate of 5 basis points. In the past, the adjustment was an automatic adjustment where the discount rate was automatically dropped based on this table. But that more recently, the board made some adjustments to this policy. And if we go to the next slide, we can kind of cover those changes. It changed just recently in April. We basically no longer have an automatic reduction in the discount rate. We notify the board that the event occurred, and then we'll have a discussion and an agenda item with the board to go over the potential impacts of reducing the discount rate. And then the board will make a decision based on our presentation. This presentation is going to happen in the Finance and Admin Committee. It actually is going to happen this month, actually next Tuesday. The agenda items are already out on the webpage. So for those who are curious and want to see what's contained in that, you can just go out to our website and look up the agenda item. Some key considerations, we think that were brought up during the agenda item is, we're going to be conducting a full and formal ALM process next year. And, while asset returns were positive last year, they continue to be volatile. And based on, a number of these factors, our recommendation was not to change the discount rate and to keep it the same, especially going into the ALM process next year. It just seemed to, from our perspective, it made more sense not to kind of jump ahead and make any changes now and just take a more thorough approach next year. That item is, again, on the webpage, and you're more than welcome to go take a look at it. Next page. So what would happen if we did change the discount rate? We kind of have laid out both sides here. Basically, if the change to the discount rate occurred, there'd be an impact both on the employer normal cost side and the employer unfunded amount. And these would first be reflected in a 26-27 valuation year. Obviously, if we don't drop the discount rate, there'll be no changes to or any additional contributions based on dropping the discount rate. Next slide. Also, when we change the discount rate, there is a potential impact for employee contributions. Were the discount rate to change, we estimate that around 3% of the rate plans would see Pepper employee contributions changing, affecting roughly around 7,500 employees. Again, this is only if the board were to go ahead and make a change to the discount rate. But this information is available so they can help guide them in their decision. Next slide. Okay, so before we kind of look at the impact of what this investment return has to rates, let's take a quick look at where are we at right now. The 2023 valuations just came out within the last month. And if you go to the next slide, we kind of have a summary here of some of the results of the public agency valuations. We have it broken down by safety plans, miscellaneous plans, both pooled and non-pooled, and we added the schools pool as well here. And what you can see is, if you look at the first set of columns here about average funded status, the funded status dropped just a little bit between 22 and the 23 valuations. The returns were, under the 6.8% discount rate, and that dropped our funded status slightly. Also, you can see the average employer contribution rates increased between 22 and 23, pretty much across the board. That was reflective of the lower discount rate or the lower investment return compared to our discount rate. Next slide. So what's that mean for 24? Next slide. So let's kind of give perspective here. What's that investment gain mean? We just have a sample plan here. We put 100 million in assets on the left-hand side. Start out beginning of the year with 100 million in assets. What we expect is, we expect 6.8% return. So at the end of the year, we expected an additional 6.8 million of assets for the fund. With the 2.4% return investment gain, that gives us also an additional $2.4 million worth of assets. As you can see, that little green bar at the top compared to where we expected total investments to be. Next slide. So when we have any gain or loss in the system, we try and smooth out any of those fluctuations in terms of incorporating that into the rates. So right now, CalPERS has a 20-year amortization policy. So in the case of the recent gain that we had on the investment side, what we'll do is we'll amortize that over 20 years. So in this example, we took the $2.4 million, we amortize it over 20 years. You can see that kind of creates a reduction in your required contribution. For the investment gains and losses, since they're so volatile in terms of contributions, we have an additional smoothing on the amortization where we kind of ramp up the contribution over the first 5 years. And you can see, and you can kind of see that in the graph here, where that payment kind of increases. You start think about it as it's 1/5, 2/5 working its way to 5/5 or a full payment. And then in the 5th year, and then that payment stays level for the remaining 15 years. So you can see how the gain of 2.4 million is spread over the upcoming 20 years and reducing your contribution. Now, what we've also added is we've added the green line at the bottom and illustrated how, as a percent of active payroll, how much of a decrease in pay contributions as a percent of pay that these contributions reflect. You can see it starts out similar. You have the ramp up for the full contribution, and in this case, it starts out. It goes up to around 1.5%, and then kind of works its way back down to 1%. The reason you see kind of like a decreasing percent of payroll is because we amortize gains and losses as a level dollar. So that dollar amount stays constant over the next 20 years. And when you think about your payroll over the next 20 years is going to be increasing. So if you take a level dollar and divide it by an increasing payroll, you're going to get a decreasing percent of pay. Next slide. This is another example. We just looked at this sample plan. This is a little bit more typical of, say, a safety plan, where, again, the amount's still the same. 100 million gave us a $2.4 million increase. The dollar amounts are the same, but depending on your payroll and the ratio of your payroll to your assets, the greater the assets are to your payroll, the more volatile the contribution percentage will be. You can see here, the percentages here are almost double what they were in the prior slide. The dollar amounts are the same, but if you are comparing it to your payroll, you get a little bit more volatility when you look at that particular measure. Next slide. So what we did here is we looked at, various miscellaneous plans, because as I mentioned, we pick a typical plan. We have, several thousands of plans out here, and, your asset value, ratio of your payroll to assets, the funded status, all those figure into what the gain will be for your particular plan, and how it impacts your rates. We have several examples here. We have typical plans. If you look at the second line, plan 2 for a larger plan with the 100 million, that corresponds to those previous graphs we talked about, where you had that gain of 2.4 million with $100 million asset value. This is basically to give you a sense of, as the dollar amount's going to be related to your asset value. If you have $100 million in assets, it's going to be your gain loss is going to be twice if you only have 50 million. It's proportional. You can also see We also list the first year contributions in dollar amounts. For Plan 2, since it is what we talked about in the previous graphs, it was right around 59,000 reduction in contributions in the first year, and that grows to be almost 295,000 reduction in contributions by the 5th year. We take a look at the next slide. Similar type of results for safety plans. I think the key difference between safety plans and miscellaneous plans are your asset ratio, the asset volatility ratio here, your assets to payroll. It's much larger for safety plans. Dollar amounts come out to be similar as the miscellaneous plans, but when you compare it to payroll, you'll see the volatility and the impact as a percent of pay is pretty much double. Next slide. And then finally, moving on, I'll mention again that one of the best ways for you as an agency to check your rates is to use Pension Outlook. This is like the setup screen if you go to Pension Outlook. And what this will do is this will basically allow you to go into the application with a 9.2, 9.3% return for 23-24 and get projections for your specific plan. We've talked about PERF here, we've talked about the typical miscellaneous or safety plan, but this utility basically allows you to go in, put the return in that we got, the 9.3, and get projections that are specific for your plan. It'll provide you the best information for your agency and give you a lot more detailed information. I think that's more pertinent than just the overall general numbers that we have here. Next page. Some of the things that are output for Pension Outlook, we look at the funded status over the next 20-30 years with the 9.2% return. You can see there's both a before and the after. You can see there's a jump up in the funded status, and you can see where the funded status is projected to get up to 100%. You also see contributions laid out over the next 30 years. And you can see when you put in a increase in the investment return, we get a corresponding decrease in the contributions. I'll also add that this is also a way, if you want to see what a 5 basis point impact on the discount rate would have on your contributions and funded status, you could also put a 6.75% discount rate in here, and you could see what impact that would have for your particular agency. Next slide. I think that pretty much wraps up the section on contributions. I think we go back to Stephen at this point.
Thanks very much, Scott. If you could just go through to the next page. What we've done here is put up the timeline for our asset liability management review. The areas that have been shaded out reflect the recent past, the mid-cycle review. And this review is carried out primarily by Scott's team, the actuaries, and the investment team. I've already mentioned the changes to private equity and private debt that resulted from the mid-cycle review. But our teams have kicked off some sort of informal education sessions amongst ourselves to understand better how the liabilities move through time, and also some of the high-level investment assumptions that we make. But then we more formally have a whole series of education sessions with the board and others, ultimately leading to a final recommendation on a future asset mix for the portfolio, which becomes effective in the middle of 2026. So it's a very lengthy process, but a lot of important steps along the way. And the one I would highlight probably more than any other is trying to understand the risk appetite of the board and the members, because that affects the the asset allocation. And that risk appetite relates to how we feel about return volatility, potential drawdown, what it might mean for contributions, and what it might mean for the funded ratio. So a lot of interesting work for us over the period ahead. And I'll turn back to Simone.
All right, wonderful. So that concludes our prepared remarks. It looks like we have a couple questions in the Q&A box. So I'll start there and see if any hands are raised or additional questions come in. The first two questions have a similar theme, so I'll ask them together. And I'll direct these questions. I think, Rob, you should be able to answer them. It says, when will the private equity returns as of 6/30/24 be available? Do you have the final investment return available, which usually comes in September? If yes, what is it? If not, when will it be available?
Right. Yeah, we get this question every year, so thanks for the question. What we've presented today are the final investment results, and those are the results that will be shared or have been shared with or public information for September IC next week. Context on that. We, from an investment performance standpoint, close our books as of 6/30. And so we do that so we can have timely reporting of investment results. And so that's why the numbers will not change. What we will get as of 9/30 is the 6/30, private equity results, and that will be in our next fiscal year's returns, but we do not reopen the investment book for that purpose. And if there's additional questions, more than happy to follow up on that.
The next question is, if the discount rate was automatic, what would the percent rate change be? And so I think that question is for you, Scott.
Yeah, it would be a decrease of 5 basis points, so the discount rate would change to 6.75%.
Thank you. And Sally, I'm not sure the second question, it says for non-PEPRA. I'm not sure if that was a continuation to your first question. But the PEPRA discount rate isn't different, so I'm not entirely sure if you want to raise your hand and come off mute and ask the question, or if you want to type. Oh, it was answered. Never mind. She typed at the bottom. Thank you so much. Okay, so the next question is, can you please help me understand the best way to explain to PEPRA employees that when CalPERS has a strong year above the discount rate, PEPRA employees will need to contribute more if the board chooses to take the information and trigger a discount rate reduction? It seems counterintuitive that a strong return year would trigger employees to pay more in the future. So Scott, that's a question for you.
Yeah, I think one way to think about this is what happens is if the board makes a change in the discount rate and say lowers it, what that means is we are now assuming that our investment return is going to be lower, not just for the year that just happened, but for every year going forward for the next 50, 60 years. So yes, there was a gain. So what happened was there was a gain. Risk mitigation was supposed to take the gain and kind of cover the reduced investment returns going forward. But with PEPRA comes along and PEPRA says the employees are supposed to pay half the normal cost. So what happens is if you reduce the discount rate, we are now assuming returns are going to be lower going forward every year for the next 50 years. That reduction in investment return needs to be made up by the employer and due to PEPRA and the employee. And that's kind of why when we, it has nothing to do kind of with the investment return. You can kind of divorce yourself between these two. It just comes down to if there's a change in the discount rate where we lower it, we're basically anticipating lower returns going forward. And since the money is not coming in from the investment return side, it needs to be made up from both the employee and the employer side. Hopefully that helps.
Thanks, Scott. So this next question, I think, has to do with slide 27, if you want to bring that back up, Renee. It says, should we use a 9.2 return versus a 9.3 return on the pension outlook tool? The difference is due to question mark?
That's mine as well. So, the reason we have 9.2 is the 9.3 was the preliminary return, Rob talked about as of the end of June, and that's the investment return. Two things really kind of happen. That does not reflect admin fees. Our assumption right now is 10 basis points for admin fees. So when we look at the numbers, those fees will be reflected, and that's why you're seeing a 9.2 versus a 9.3. And what I would say is it's 9.3 today, or 9.2 today. When the final financial statements come out in November, those March dates that Rob talked about will have been updated to June. And those are the values that will actually get make up the true gain and loss that you'll see in your rates next year when your valuations come out, when your 2024 valuations come out. Because what happens is we reflect the financial assets, and those assets will reflect changes that we haven't even seen yet. We're finalizing those. They get finalized September, and they go to the board and get published to the board in November. And so I would say right now, put 9.2 in for an estimate. Once we have the returns and the financial statements, you could use those numbers. I would use the return off the financial statements, and those will reflect the 10 basis points reduction. So you could just grab the number right out of the financial statement reports that come out in November.
Okay, so this second question might tie a little bit into what you were discussing, and we don't have the CFO on the call, but I think one of you might be able to take it. So I'll let the three of you decide who wants to take the question. It's kind of a statement more than a question, but you might want to clarify the money weighted rate of return available later in the year is what is used for determining the ADC, not the investment return that you're currently discussing.
I was about to make, I think that's a great statement. I agree with it. And Scott did a really good job last year of describing the differences between those returns. And you're right. The investment return we're talking about is a closed period with all of the information we have through 6/30. The money weighted return, as you're mentioning, that yes, maybe the CFO could better describe, is through all the information we have through 6/30, even if we receive that information after. And that's the money weighted return that's on the evaluations. And that's ultimately what Scott was discussing just a moment ago. I think that's a really good description, Simone.
Okay. And so the second comment I think is piggybacking. It says, I believe the discount or the disconnect regarding the timing of Invo's reports and the PERF investment return is the MVA and the investment income allocated to plans does indeed include the subsequent appraisal of private asset and GASB 68 adjustments made by the financial office, correct? Please elaborate. Is that correct? Robbie, you were shaking your head.
I believe that to be an accurate statement. Yes.
Yeah, I would agree with that as well.
Okay. Next one. Does it make sense that the investment returns do end up with the employee? Wait, hold on a second. Let me read this. Does it make sense that the investment returns do end up with the employee in the summary on their future value if the level, CalPERS, or retiree and use in their future? I always see my contribution to returns on investment. I think there might be a typo. I'm not quite sure what. Does it make sense that the investment returns do end up?
Yeah, I would just say that, when it comes to employee contributions, the account is credited. If you if you leave CalPERS, your account is credited with a 6% rate, regardless of what CalPERS gets. That's if you leave. If you stay with CalPERS, you know, your account balance is, you know, you can consider your account balance is your contributions to the system that are going into making that part of your retirement benefit and your retiree benefits that get paid once you retire. But there's no it's not like this doesn't work like a 401k plan where if the PERF has a 20% return or a negative 5% return, that kind of impacts your contributions or your contribution balance.
Thanks, Scott. And I can answer this question. Can you confirm when the financial statements will be available? Apology if I missed that part of the answer. So the basic financial statements go to the Finance and Admin Committee in November, and the annual comprehensive financial report is published on our website, typically in December. It looks like we have one question. An individual has their hand raised. Can you go ahead and unmute them, Jessica? Is it Eileen? Is that how you say your name? You're unmuted?
So
Hi.
what was the question? I'm sorry.
Oh, you had your hand up. I thought you had a question.
Oh, sorry. I must
Nope.
have hit it accidentally.
Okay, wonderful.
Apologize.
No problem. All right. Are there any other questions? I don't see any in the chat or any other hands raised, so I'll give a second to see if any others come through. Oh, it looks like Ryan has his hand up. So can we unmute Ryan? Ryan Green?
Yeah, just a quick question on the tool that you use to project that you guys pulled up there. Right now, if we have like a classic and a PEPRA or a safety and a miscellaneous, it's multiple different ones, so it's hard to get like a global picture. Is there any plan in the future to allow an agency to sort of see individually and a combination of them? I'm not sure if you follow that. I can try to repeat it if right now the ALM projection tool that's online where you were putting in the 9.2, it breaks it down between like your PEPRA and your miscellaneous employees or your safety employees and your miscellaneous. And a lot of times we're trying to get the projection for an entire entity. And so I wondered if there was any functionality looking in the future to have the option for an agency to either look at it individually or on a combined basis, or maybe there is a way already.
Yeah, I thought I don't have it in front of me. I thought the utility on the cash flow had everything on an employer level, but we can definitely take a look at that and yeah, I know what you're asking. I just am kind of drawing a blank right now on exactly what breakdowns are available and which ones aren't. So we could take a look at that and we can get back to you on that.
Thanks.
Scott, there's a comment in the chat that says if you export the forecast tool Excel, it includes the combined forecast.
Yeah, I thought there was one part where we combined something. I just couldn't remember what part was. So someone mentioned there was the export part has a combination of it.
Great. Are there any other questions? We still have, it looks like about 9 minutes. I am not seeing any. Let me just scroll through the questions, make sure I didn't miss any. Well, it looks like Dawn, go ahead and unmute yourself. I'm sorry, Dan.
Hi, thanks. Obviously, over the last couple ALM cycles, CalPERS has decided to lean into private assets and retreat from public equities. And obviously there is some calculus involved in the obvious benefit of a higher return to private from private equity or private assets. The two costs I would see, for agencies is a little less transparent in terms of what those assets are, as well as how illiquid that asset class may be. I'm sure that enters, you're including that in the whole picture, but when you look at the total swing from private equities to private assets over the last two cycles, it's been a fairly substantial retreat. So, just for the group, perhaps getting a better understanding of why private assets have been so attractive, and if you have any liquidity or concerns about the liquidity of those asset classes.
Thanks, Dan. I'll take that question. When we go through the asset liability management process, one of the key inputs is our capital market assumptions, what we think the prospective returns will be on the various asset classes. And you're right, we need to think about things beyond just return. We need to think about the riskiness of those exposures. We need to think about, you refer to transparency, and we also need to think about the liquidity. If we are investing in private market assets and we have less liquidity, we will require an additional expected return for that. So those things have to be taken into account. I think we do have a relative advantage over some of our peers in the sense that we have perhaps somewhat less allocated to some of the private markets than some of our peers. And so that gives us a bit of an advantage when we're thinking about making new investments. But these investments need to compete with investments across the whole portfolio. So it comes down to that prospective return, the prospective risk, and making sure we get rewarded for locking up our liquidity.
Great. Did that answer your question, Dan?
It did. Thank you.
You're welcome.
And thanks for the question.
It looks like we have time for one more question, so we'll go to the chat. When would the board make a decision on the results of the ALM process? You want to take that, Stephen or Rob? Or
well, it's actually it's a process that I guess Scott and myself, along with Michelle next, will be closely involved with for quite some time. You'll see that coming to a fruition early 2026 or late 2025. But we have education sessions along the way, so you'll see it develop through time.
Yeah, on the timeline, it shows in November that as of tentatively right now, the final approval for the strategic asset allocation and or any changes to the discount rate would come in November. I think that's probably what Jane was looking for. Okay, well, for the sake of time, I will just conclude that today's webinar was recorded, and we will be posting this archived recording on our YouTube page in the coming weeks. So if you were unable to view the whole thing, or you have colleagues that would like to view it, you can do so there. If you have additional questions that weren't answered today, I would just ask that you reach out to our stakeholder relations mailbox. That's stakeholder_relations@calpers.ca.gov. We will email those that registered for the webinar a copy of the PowerPoint presentation in addition to a link to the YouTube video for your convenience. We really appreciate the panelists' time today in providing this information to you, and we appreciate your time in logging in and listening and asking the questions of the panelists. So for that, thank you so much, and until next time.